on Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Joining me in the studio from Envision Financial Services, as the pre-recorded intro just said, Luke Smith.
Good afternoon.
I like to make sure people get the message.
Well, it'd be a bigger problem if someone else sat down, I'll tell you that.
Absolutely. We're here to talk money matters, of course, once again. And your topic today is quite interesting. Misconceptions in 2025, how to avoid losing money. Well, in any particular year, I think we should be interested in avoiding losing money.
Completely.
But what are these misconceptions of 2025 that have you worried?
Yeah, well, I'm not so much worried, but I just want to try and dispel a few early in the year because I find it really interesting when people come in and hit me with what the ladies have said at Mahjong, or what the guys are talking about at golf, or what Billy said, and Billy's a plumber, and plumbers are great at being plumbers, but maybe don't take your financial advice without checking it where the guy giving it to you is a plumber. I'm not saying nothing against plumbers.
Or a taxi driver.
Or a taxi driver, or an electrician, it doesn't matter.
Because taxi drivers have opinions on everything.
Oh, completely. So these are some of the things that I'm getting at the moment that if we can dispel, I think it will give you a greater opportunity to make the most of strategy considerations and just demystify, I guess, some of these assumptions that I get. So the first one I get all the time of late is that you can't add money to super once you've retired. Now, that's wrong. There's two ways money goes in. One's a deductible contribution. You can do that up until 67 and not need to meet a work test. And you can make a non-concessional contribution up until 75. You can also make a downsizer contribution at any age where you sell your primary residence and you meet all of the criteria to use that. And you've also got the CGT small business concessions where self-employed people can sell their business and use a raft of different tax considerations to make a contribution to super if that works for them. So I find there's for some reason a direct connection between gainful employment and the ability to especially make a deductible contribution. And I think if people need to think outside the box, first you say, do I need to make one or do I want to? Then you need to ask yourself, what type of contribution? Because if you've got a massive defined benefit pension, you've got huge amounts of rent in your own name or you and your partner's name, and you've got distributions maybe coming out of a company, you might need to make a contribution to super just to manage the tax on those ancillary income streams. And that has nothing to do with your capacity to work, especially under the age of 67. From 67 onwards, you need to meet a work test, which is 40 hours in 30 days. But don't assume that you can't, because you could be paying a huge amount of tax on property rent, for example, when you really don't need to be.
So this idea that you can't add money to super after you've retired, I've got to ask a question here. Once you do retire and you convert your super fund from accumulation to pension phase, I thought you can't put any more in that pension phase super fund.
Correct, you can't add to that pension once it's been commenced.
Okay, so how do we add to our super?
But nothing stops you from winding the pension back to accumulation or making a contribution to another fund and starting a second pension. So you're spot on. Once you start an income stream on paper, you can't add to it unless you stop that income stream. There's another one, great segue into, I have to take this pension forever. No, you can stop a pension, go back to accumulation, add in more money that you inherited or got from a property sale, and then start the pension again. So once you start a pension, it is not set in stone. You can stop it, you can start it, you can do whatever you like to suit your situation. So I guess that's another misconception is, this is my pension, I'm stuck with it. No, you've got lots of flexibility around it. We've talked about claiming a deduction while you're not working. Yes, you can do that where it's appropriate. Here's one I get of late. My balance is over $500,000 today. I can't use the 5-year catch-up concessional legislation. Now, the point here is, it's not the balance of your super when you make the contribution. It's the balance of your super at the previous 30 June. So, example, I have $520,000 in my superannuation today, and my advisor says, hey, put in $50,000 and you'll get a tax deduction. Client says, oh, but I can't. I say, your balance was $490,000 on the 30th of June 2024. Yes, you can. So I find that one limits people's view on that strategy a lot. So I just want to clear that one up. Balance at 30 June in the year before, not when you make the contribution. You've got a full 12 months to sort that out. So again, not the balance now, the balance at 30 June. Another one I get and this is especially relevant for local people, I'm in the PSS, I can't make any additional contributions to super. Now, partially correct. You can't make additional contributions to the PSS, the CSS, DFRDB or MSBS. But you can make a contribution to another super fund 100%. And on a lot of those statements, so for example, the PSS, on page 5 of your annual statement, it tells you in a box exactly how much you can put in. Because it says, we've assigned $10,000 to the concessional cap. Now, if the limit's 30, that means you can put in 20. Now, you can't put it into PSS, but you can put it straight into another fund, claim 100% of that money as a tax deduction, and help your broader tax position. So for all the defined benefit members out there, don't assume that you can't. Check and see how much room you have, because your fund will tell you. And then if it's appropriate, think about using a normal accumulation fund to receive benefits and lower your taxable income.
Next on the list is a big one that we have discussed in the past and relatively recently, I think. But the idea that your kids won't be paying any tax when you die and they collect your super, well, that ain't necessarily true.
Spot on. And we did a show just a couple of weeks ago on looking at the taxable component of your superannuation, because adult children are deemed non-dependents under the tax rules. The superannuation environment deems kids as always dependents, but the super rules and the tax rules are very, very different. So make sure that you've checked your taxable component inside your fund. And a lot of again, misconception there is, oh, but I'm over 60, it's tax-free. Yes, to you. But if you get hit by a bus and it goes to your 35-year-old and there's $100,000 left in your super, your 35-year-old is going to be down $17,000 on that 100. So it's worth looking into and getting fixed. And we've addressed that in a specific show in the past.
Yes.
The next one I get all the time is, an industry fund lets you control franking credits and pays you an income stream. Well, yes and no. You've got no control over the use of franking credits in a standard industry fund, because they are treated as master trusts. So they are taxed at a fund level. So you get no control over the distribution of franking credits. And an industry fund doesn't pay dividends from investments. Yes, you can draw an income stream in the form of a pension, but what I'm referring to here is, unless you've held individually listed shares, which some industry funds will let you do, your standard balanced option at most is a unitized fund, so it reflects the total return in the value of the unit of the investment choice that you are in. It does not pay dividends during the year. So be mindful of that, because I find the greatest two concerns people have when they retire and turn off that salary tap is it going to last forever? And how am I going to fund my pension? And I'm a big believer in controlling the income that your assets generate, so that you can fund a lot of your lifestyle with distributions and limit the need to access capital in some situations.
Next on the list is one of your favourites, isn't it?
Yes.
Self-managed super funds.
Yes. So I get this one all the time. Oh, self-managed super funds expensive. Says who?
Well, all things are relative, aren't they? It depends. Isn't that your favourite answer?
It depends, exactly right. Now, what do I mean by that? The self-managed super fund is probably the cheapest superannuation structure in this country, where you have a balance in excess of, I think you could probably go as low as 1.2.
Mm-hmm.
Anything over that, you are running a very, very cost-efficient machine. I say that because superannuation funds now are priced at a fixed rate. With a lot of industry funds and a lot of personal super funds, they will have an administrative cost to be in the fund that is tiered. So the more you have, the less you pay. With a self-managed super fund, to get the tax and the audit done, generally now, flat price. It's not tied to the number of assets. It's not tied to the market value. If you have some additional complexity in your fund, then you could expect to pay a little bit more. But if you had a traditional portfolio of assets, 25 to 30 shares, managed funds, ETFs, some term deposits, some bank accounts, now we're seeing the cost of those run between sort of 2,400 and about 2,600. Right? If you're paying any more than that, shop it around. Or if you're getting great value from the person that's providing it, wonderful. Stay there because they understand your situation. Because cheaper is not always better. But big misconception, these are expensive. No, they're not. They are if you have $200,000 in there, but then you'd argue that it would be inappropriate for you to use that. Be like me going and buying a Ferrari and then delivering bread in it. Mm-hmm. It's not going to be the most efficient way to deliver the bread.
Indeed, but of course, if you have, your own personal racing track, then a Ferrari's great.
Happy days. Let's go. Say less. So exactly, it's the context. Again, you've got to come back to a structure and say, why have I got it?
Yeah.
What is it doing for me? Like you would with any asset. This one I have, especially from younger people. I need to have $10,000 or $20,000 to start investing. No, you don't. There are so many ways now to go out and start something, because the best thing any grandparent could do, or any parent could do, or any young person could do, is start a little portfolio a little bit sooner. And if I could swap you don't know what you don't know for something, it would be do a little something a little sooner. You can go to a micro investing app. You can go to a Beta Shares. You can go to a Vanguard. You can go to a BlackRock. There are loads of providers out there that would allow you to open a diversified ETF with as little as $100. But the benefit is the time that it's invested, and you adding a little bit every week, every month, every fortnight, every year to take advantage of compound interest and earnings. And if you ever want to shock yourself, get on a ChatGPT or Copilot and ask it, hey, if I had this much invested for this long, what would it be worth? And then say to it, if I added $100 a week, what would it be worth? And the difference will shock you. It is unbelievable how the benefit of time and compounding can be exponentially beneficial for your assets.
It's about 10 minutes to 5. Luke Smith from Envision Financial is with me in the studio today. We'll be back with more misconceptions in money matters just after this. Well, it's about 8 minutes to 5 now. Luke Smith from Envision Financial is with me in the studio here today, and we're running through a list of misconceptions that people have about managing their money. Now, we still have a few items left on our list, Luke. So the next one up is about your will.
Yeah, so this one I get all the time. I've got a will that'll take care of all of my assets. No, it won't. And the big one there, whilst most solicitors would argue that there are intricacies there, and I completely agree. The big one I'm referring to here is your superannuation. So your will has no control over the direction of your superannuation, and that's where you use something called a binding death nomination or a reversionary pension. So a binding death nomination says, I've died, I've eaten too many mushrooms, and if I don't wake up from those mushrooms, my wife gets all of my superannuation. And it goes to her unchallenged, unquestioned, and it removes the discretion of the super fund trustee.
And that nomination is not in your will, that's in your superannuation.
Exactly right, because your will covers everything outside in relation to what you go. And I can't stress enough here, good advice in this space is invaluable when you think about what you are protecting and what you've amassed against the potential legal implications of having poor documentation or the assumption that something is and it isn't. Get some advice in this space, especially where you've got trusts and companies and directorships. A good good lawyer here will add massive value to position and alleviate the pressure on your family in the event of your passing. So binding domination is very different to a will. So make sure all of the water runs down the same river so you don't undo good estate planning work.
Indeed. Now, our next item is, I don't know about you, but one of my favourites.
Yes.
A balanced fund is not necessarily balanced.
No, that's right. So we need to put some context around this one. Balanced is just a label, okay? It's a bit like anything. You say, oh, that's fat, that's skinny. Relevant to what? And the problem is people don't know what the what is. And I use the analogy regularly that if I've got a car driving down the road at 100 kilometres an hour and I've got a blue Mazda and you've got a green Mazda and you're doing 140 kilometres down the road, you can't get to the destination and say, I have the fastest car because it's green. You need to say, I was driving at 140 kilometres an hour. What a balance fund does not give you in its name is the asset allocation. So you need to look and say, what is the allocation of growth assets inside of that selection? Because the balanced option at Australian Super may have a very, very different speed to the balanced option at Rest or Care or another industry fund. So don't go by label, dig a little bit deeper and look at the asset allocation, which is the percentage of assets that are growth, which would be Australian Shares International Property and Infrastructure. And then you've got your fixed interest, which would be cash, term deposits, and sometimes they use language like private equity, which no one really knows what that is. But they would be your defensive part of the portfolio. For me, balanced is 50-50. For an industry fund, they are as far from balanced as you could want to be. But don't look at the label, look at the asset allocation first so you can compare fund to fund, because it can be very misleading.
Yeah, so if you've got one fund at 60-40 and another one at 70-30, you're not really comparing, as they say, apples with apples.
And everybody sees the ad of, oh, look at this, da-da-da-da-da. But that doesn't say that, well, this fund was doing 80-20 and you've compared it to 50-50.
Yeah.
It's impossible. You just can't win.
Okay, last one. Your entire super fund is used to work out your Centrelink asset test value. Well, is it?
No.
Okay.
And I'll explain why. Let's say I'm 70 and my wife is 62. All right? My assets in super are accessible because I'm over age pension age. If I took money out of my account and put it into my wife's account and she does not start a pension, that money is invisible under the asset test for Centrelink purposes. So if you've got a position where, say you're in a self-managed super fund with $1 million and you want to get the balance of the older person down, let's say it was, I had 650,000 and my wife had 350,000, I could take money out of my account, take it below the asset threshold of 470,000, put the money straight back into super as a non-concessional contribution for my wife. She does not start a pension. That money that's in her name doesn't exist in the eyes of Centrelink, and I can stroll in and say, hey, I've got 400 and I get full benefits, excluding some other considerations. But again, a lot of people come in and go, oh, but we've got this balance. And I said, well, I don't care what we have. What do you have? And then let's make it disappear.
All right, time to ask, where can listeners get more information?
Yeah, so office number 62604749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. And we've got Envision Financial Canberra on YouTube, where you can subscribe and get the back catalogue of all of our shows. And all of these things are in Smart Money Strategy, your ultimate guide to financial planning, in all good bookstores and online.
And indeed it is. Luke, thanks very much for popping by.
See you next week.
We'll catch you next Friday afternoon. Luke Smith from Envision Financial back with us at the same time next Friday, right here on 2CC.